Hi everyone. We have already dealt with the different aspects under the goodwill calculation, the NCI measurement, and we talked about, of course, also the measurement in in respect to the day one accounting when we acquire the business, right? What we now want to talk about is we want to deal with some items for which there is a requirement for a subsequent measurement as well, right? We talked about, if you recollect, the contingent consideration, for example. We talked about also indemnification assets, indemnification items. We talked about contingent liabilities, right? So all those aspects, how do we deal with those, is something which is covered in this brief section of subsequent measurement. We say that an acquirer shall subsequently measure and account for assets, liabilities, and the equity instruments as per the relevant Ind AS, right? Depending on what is the character of those respective items. But then there are specific items for which Ind AS 103 is applicable, and accordingly need to treat them on the same basis, right? It would be confined to, for example, the reacquired rights or contingent liabilities or indemnification assets or contingent consideration as well. Okay. For example, if it says there's a reacquired right, then it is recognized as an intangible asset and shall be amortized over the remaining contractual period, right? But in case the acquirer sells that reacquired right, shall include or consider the carrying value of the intangible asset to determine the gain or loss on sale. So this would be a very straightforward accounting treatment of the reacquired right as an intangible asset, and accordingly the accounting shall follow. Okay. The contingent liabilities would normally be, on the day of, initial recognition, be determined at fair value, but at a later point in time would be taken the higher of whatever is the value of that liability under Ind AS 37, or the amount that is recognized initially subject to any income that is likely to be recovered or available against that particular liability, right? For example, if I say that I'm given this scenario, Soft Limited sells cola drinks, and its experience suggests that 1 in a million soft drink that has been sold is contaminated as harmful to health. This is the prior trend or history, etc. Now, Soft Limited was acquired by Tough Limited, and until that point in time, Soft had already sold 1 million such drinks. Now, the question is that should Tough Limited provide for the liability on the starting point itself? Well, we say that there is no present obligation, but only a possible obligation in this case, right? Unless that event has taken place, the need to recognize the liability does not arise in this case, of course, right? It would only be done in the post combination, period when the need for such a possible obligation is likely to become a present obligation, right? That's something which is about the reference to the contingent liabilities we want to kind of consider here. Okay. On the indemnification assets, you would recollect that you normally look at the possible or the contingent liability and the corresponding indemnification asset to the extent of that liability that can be recognized, right? So we talked about all those aspects of paying the settlement cost, of an earlier case, or there is a likely position on the taxation, and there's a likelihood of recovery of that as well, which is all due. So the way we look at the subsequent recognition and measurement is straightforward. Okay, the way we accounted for the indemnified item to the extent it is shown at fair value, even the indemnification asset to the extent of the recovery of that indemnification asset would be also recognized at fair value. And then you need to understand that from the perspective of let's say collectibilities, right? Let's say in case of a tax demand for that matter, you would need to make some adjustments around those in terms of what is the collectible amount, right? Of course, the derecognition would happen when the amount has been collected or it has been sold off, or if that transaction has become, has become an obsolete transaction. So from that perspective, the accounting would follow, right? Let's take a small example. Now, this would suggest in terms of, how to deal with such kind of scenarios there, right? It says that on 1st of April 17, Moon Limited, whose 100% voting shares are held by Earth Limited, is acquired by Sun Limited in a business combination. Okay. Now, at the time of acquisition, there are two pending litigations against Moon Limited. One is the major client of the company has alleged a breach of important clause and therefore suing Moon Limited for damages worth 10 crore rupees. So there is an indemnification item here. Similarly, there is a litigation for the taxation wherein there is a dispute over the tax returns for a particular year. Right? In case of the first litigation, Earth Limited has agreed to indemnify Sun Limited for the losses up to 5 crores. And in the second scenario, Sun Limited has received an indemnification again from Earth Limited to cover the outcome from the tax authority. The question is, you're required to suggest how should these, transactions be dealt with, assuming in the first scenario, the fair value of the contingent liability is 3 crore rupees. And in the second scenario, an outflow is probable and the amount expected to be paid is 2.6 crore rupees. The fair value of the liability is 2.2 crore rupees. Now, put simply, in this case, when you look at the first instance, there is a contingent liability of 3 crore rupees, and there is also an indemnification asset to the same effect, right? So that corresponding value would be recognized and brought into the accounting there and then. Okay, but as far as the second scenario is concerned, right? So this is the first scenario, of course, we referred to. As far as the second scenario is concerned, the tax demand to the extent of 2.6 crores, right? We are given that the amount expected to be paid is 2.6 crores, and that is something which is going to be claimable, and to that extent you would create an indemnification asset in this particular scenario, right? So the difference between the two sides is, one is for the contingent liabilities, you look at the fair value to the extent of recoverability, you also determine and measure the indemnification asset, right? So the 3 crore comes into the picture. But as far as the uncertain tax positions are concerned, you look at the amount which is expected to be paid or something which is payable, and you bring it into the conversation here. All right. Let's have a look at the formal solution. It says that, of course, in the purchase price allocation, the amount of 3 crores is recognized, and so is the indemnification asset to the extent of 3 crores would be recognized there and then, right? In the second scenario, however, you recognize the liability to the extent of 2.6 crores, which is expected to be paid, and accordingly, the indemnified item or indemnified asset would also be, indemnification asset for that matter, would also be recognized to the extent of the same amount, assuming that there is no risk of uncollectability. Okay. As far as contingent consideration is concerned, we dealt with that. We discussed that beforehand. So there is no change in that part. A contingent consideration is necessarily measured at fair value through profit or loss, which simply means that it would be measured at each reporting date at fair value, and the changes are recognized through statement of profit or loss. Okay. If I say, for example, let's say company X acquires company Y, and it might pay 10 crore rupees after 2 years, subject to some conditions. Maybe the revenue share increasing, or the profit share increasing, etc. So if I say that on the acquisition date, the fair value of this amount is, let's say, 8 crore rupees. Okay. And after 1 year, the fair value of this amount comes at, let's say, 8.6 crore rupees. Effectively, we are saying you would increase the value of the liability to the extent of the difference of 60 lakh rupees. Okay, that is something which is the accounting requirement as far as Ind AS 103 is concerned for the subsequent measurement of such contingent liabilities. All right. So very, very brief section that we have discussed here, and it says, as far as the reacquired rights are concerned, they are amortized, and accordingly, you would be able to recognize a gain or the loss basis the carrying value of this particular reacquired rights. Contingent liabilities taken at higher of the amount that you would recognize under Ind AS 37, or the amount initially recognized less any cumulative recoveries or incomes against that contingent liability. Indemnification asset, again, is the same as the basis of the indemnified item, or the liability as the case may be. And finally, as far as the contingent consideration is concerned, you would normally recognize them at fair value through profit or loss, and the changes would be measured through or recognized through P&L. As far as a contingent consideration for equity is concerned, it is not remeasured. It is not remeasured at all. All right. Thank you very much.